So the second part is starting with the case second and proposition one with the figures, and by this way it is more understandable with the numerical values. So EBIT we are assuming here that EBIT is 25 million, tax rate is 35%, debt is 75 million, cost of debt is 9%, and unlevered cost of capital is 12%. So that's a scenario provided. Now, what we are doing, we are trying to figure it out the value of unlevered firm, and we see here that 25 million, which is EBIT into 1 minus tax rate divided by the rate of, we just saw this formula with the rate of unlevered firm, which is a cost of capital, which is 12%. So we divide it. So we get it 135.42 million for a value of a unlevered firm. Now, if we learn the formula for levered firm, and we see here that 135, which is a value of a unlevered firm, plus 75 is the debt what we are getting into the tax rate. So that is going to give us a 161.67. So what is a equity? 161 minus 75 is 86. So we see here that the equity is going to be reduced by 86 and from 135, and the value of the firm with the leverage is more than value of a firm less than leverage. So this graph is also reflecting that how much the total debt is as the total debt is increasing. If the debt is zero, the value of the levered and unlevered firm, because there is no leverage, so it's going to start it from there. So the value of the levered firm is going to stay same as we are. This one is a value of a levered firm, and the slope of this curve is TC, and we see here that the tax shield or tax shield is increasing because TC into tax rate into D is creating a difference between the value of a levered firm and value of a unlevered firm. Value of an unlevered firm and value of a levered firm. So we see here that value is of a levered firm is 7,000 and value of a unlevered firm is 7,000 and value of a levered firm is 73,000. 7,300. So the value of the firm increase as the total debt increases because of the interest tax shield. So as we are increasing debt and debt, so the value of a levered firm is increasing as compared to value of unlevered firm, because unlevered firm is not going to change because there is no tax benefit. So the case second and proposition second, the WACC decreases as DE increases because of the government subsidy on interest payment. Now, this is a subsidy we consider because of that the tax interests are tax deductibles. So WACC is E over V into RE plus. Now we adjust the WACC with the tax rate. This is the adjustment of weighted average cost of capital with the tax shield or with the tax deductible. So we rearrange that RE is equal to RU plus RU minus RD and to D over. So example is here is 13 point. So we see again the debt is this much, equity is this much. So this is debt over equity. This is a return on unleveraged firm. This is a debt cost, a return on debt, and this is one is a tax shield. And by this way, we see that the return on equity is 13.69 as compared to unlevered firm has and the cost of WACC is 10.05, 10.05. So weighted average cost of capital is 10.05 as so suppose the firm changes its capital structure so that the debt to equity ratio becomes 1. So what will happen to the cost of equity under the new capital structure? So RE is going to be because we are changing debt to equity ratio 1. Equal 50-50. So we see here what will happen to the weighted average cost. and the weighted average cost is going to reduce to 9.9. So we see as we are borrowing more, the cost of equity is not changing. You see here, yeah, the cost of equity is increasing, 13.95 from 13.692, and the weighted average cost of capital is reducing. This is reducing from 10.05. So that's the case. Cost of equity and WACC. So cost of equity is going to increase when we increase the debt to equity ratio. And the reason behind this is the financial risk. And the WACC is reducing. So that's very interesting to note that the WACC is reducing and cost of equity is increasing. So now, the third scenario is that now we are adding a bankruptcy cost, and as the D ratio increase, the probability of bankruptcy increases. We all know that the increased probability will increase the expected bankruptcy cost, and at some point, the additional value of the interest tax shield will be offset by the expected bankruptcy cost. So this is the point where we reach where the debt is increasing so much that the bankruptcy cost is gradually increasing over the increase in debt. And by this way, we are reaching to eliminate the benefit of a tax shield. So at this point, the value of the firm will start to decrease as the WACC will start to increase as more debt is added. So bankruptcy cost, there are different bankruptcy cost we can talk about. There's a direct cost, legal and administrative cost when the firms are going to become bankrupt. There's an ultimately cause bondholders to incur additional losses, disincentive to debt financing, and financial distress, significant problem in meeting debt obligations. And most firms that experience financial distress do not ultimately file for, do not going for a bankruptcy. So these are the bankruptcy cost attached, financial distress, direct cost for bankruptcy. More bankruptcy costs are indirect costs. These are the direct costs, and these are indirect costs, larger than direct cost, but more difficult to measure and estimate. Stockholders wish to avoid a formal bankruptcy filing, and bondholders want to keep existing assets intact so they can at least receive that money. Asset lose value as management spend time worrying about avoiding bankruptcy instead of running the business, and that also have lost sales, interrupted operations. And so if there is a news in the market that the firm is in a problem, so then the starts different types of problems, and these are all the problems when there is a news that the firm is in a problem. Now we going to talk about different theories. That's a static theory of capital structure. That what combination, and one thing make it very clear in the mind that there is no ideal prescribed combination of debt and equity that is going to be very beneficial for the corporation. So that's why we are going to talk about these static theory of capital structure. So what the optimal capital structure is? A firm borrows up to the point where the tax benefit from an extra dollar that is exactly equal to the cost that comes from increased probability of financial stress. That can be a possible answer. This is the point where the firm's WACC is minimized. So that if we look at this graph of WACC, which we just saw there, you see this is the point where it is at its minimum, and it's after this it's going to start rising. So we have to select a point where we are the WACC is minimized. The WACC is minimized. So static theory and firm's value, the stack. So firm's actual value is gonna start decreasing after some time. Optimal amount of debt is this, where the firm's value is at its maximum. Uh, and that combination is going to be the good for this particular firm. So And on the other side, you see that, as I just discussed, that the WACC is going to decrease and then starts increasing. So uh, it's just like a similar, like in economics, when we say that what is an efficient scale of output. So efficient scale of output is where your average total cost is at its minimum, right? So it's the same thing, that we have to borrow up till the point, or take leverage up to the point where your average weighted average cost of capital is minimum. That's the point. So what we can conclude from all this is that no tax or bankruptcy cost, no optimal capital structure. You can adopt anyone, right? Because there is no bankruptcy cost, there is no taxes. So it doesn't matter that which combination you are using. Uh, Corporate tax, but no bankruptcy cost, then it is good that you have to go for 100% debt, because that's you get a maximum tax shield. Case three is saying that each additional dollar of debt increase the cash flow of the firm. Case three is corporate tax and bankruptcy costs. So optimal structure is a part of a debt and part of an equity, but how much equity and how much debt so occurs when the benefit from an additional dollar of debt is just offset by increase in bankruptcy cost. That is the way where the WACC is at its minimum. So this is the conclusion from all the examples what we discussed uh, under three different scenarios. The one is with no tax, no tax, no bankruptcy cost. In that case, it doesn't matter whether you use 60/40, 40/60, or 80/20, whatever. It doesn't matter. But in case if there's a tax benefit, if there's a tax benefit, like there is a corporate tax and there is no bankruptcy cost, in this case, it is good that you do your business 100% with the borrowed money, because every borrowed money is going to add up into your cash flow by getting a tax shield. The third scenario is with the tax, with the corporate tax and with the bankruptcy cost. What is going to happen is that you have to go up till that point of taking debt where your back is at its minimum, or the benefit what you are getting from additional borrowed dollar in terms of cash flow is equal to the cost of the bankruptcy. So this graph is summarizing where we gonna go. You see here the WACC is at its minimum. That's the point we have to select under third scenario. Under first scenario, it is going to be straight line. And under second scenario, we see that is going to be, that's the second, that the equity is going to be, cost is increasing. So this is case one, this is case two, and case three. Now, what is some managerial recommendations for from the perspective that if we are how much the capital, or how much is the debt combinations. So the tax benefit is the only important if the firm has a large tax liability. That's important. If the tax is very small, like your EBIT is small, and the tax that you are paying on that is small, then it's not going to be paying more. So risk of financial distress, the greater the risk of financial distress, the less debt will be optimal for the firm, like a risk of financial distress, because when you go for a debt, your financial distress increases. The cost of financial distress varies across firms and industries. As a manager, you need to understand the cost of your industry that particularly you are. So this is an extended pie model that explains that what is going to happen with a lower financial leverage. Now, if we see that lower financial leverage, the biggest portion of this pie is going towards the stockholders claim. Then we have a bondholders claim, then we have a bankruptcy claim and tax claim. So we see here that stockholders claim is the highest, and there is a very big chunk going to the tax. But when we go for a higher leverage, financial leverage firms, so we see that the stockholders' claim is going to be reduced, the bondholders' claim is going to be increased, the tax claim is going to be reduced, but bankruptcy claim is going to be increased. So this picture, this pictograph is reflecting a very effectively that what is going to happen if we go for a leverage. So if it is a low leverage, the most benefit is going to be this pie or pizza is going towards the stockholder. If we go for a high leverage, the bondholders portion or part is going or share is going to increase and squeeze the stockholders share. On the other hand, the bankruptcy cost is increasing as compared to the benefit of the tax. So value of a firm is marketed claim plus non-marketed claims, and market claims are the claims of a stockholders and the bonds. Non-marketed claims are the claims of the government and other potential. So in this graph, if you look, uh, uh, if I use this, so this one is a non-marketed claim, and the rest of the is a marketed claim, right? And in this case, when there's a leverage, we see that the marketed, again, this is the portion which is a non-marketed claim. So no, so the overall value of the firm is unaffected by the change in the capital structure. The division of the value between marketed claims and non-marketed claims may be impacted by the capital structure decision. Many shortcomings of a static theory. Many large profitable firms use little debt. Why? Selling securities is expensive and time consuming. If a firm is a very profitable, it might never need an external financing because they have retained profit through which they can expand their businesses. So there's a one theory that explains this capital structuring. Sorry, pecking order theory. So firms will use internal financing first, and then they will issue debt if necessary. Equity is sold at last resort. So managers are sensitive to the signal that they send with the issue of new securities, because by this way they are saying. So firms don't have a target capital structure. Profitable firms use less debt. They have a greater internal cash flows and need less external financing. However, the companies with a want financial slack and stockpile internally generated cash as a result. And capital structures does differ by industry. It's not same for every industry. Seems to be connection between different industries' operating characteristics and a capital structure. Firms and lenders look at the industry's debt equity ratio as a guide to look for a particular area. Now, the what is a process for bankruptcy? The last point we want to discuss here is the process of a bankruptcy. So business failures, business has terminated with the loss to creditors. Legal bankruptcy, petition federal court for bankruptcy, and then technical insolvency, firm is unable to meet debt obligations. Accounting insolvency, book value of the equity is negative. So these are the different terms we use for bankruptcy. Business failures, businesses has terminated with a loss to creditors, like definitely the creditors are not going to get it any uh, uh, payment. Legal bankruptcy is when you go to the court of law to declare the firm as a bankrupt. Technical insolvency, a firm is unable to meet. So these are different stages and different aspects of a bankruptcy. Sometimes the firms go for a technical insolvency, but get out of this situation without going into a legal solvency. Sometimes the firms are facing the accounting insolvency, but it's get out of that situation without going into the legal bankruptcy. Business failures, when business fails, then definitely there's no way out. But in other ways, it can be possible. But ultimately, the way is that a legal insolvency, bankruptcy, when you go for in the court of law to decide that the firm is not able to uh, meet their obligations. So process is going covered under the Bankruptcy and Insolvency Act 19. That's a liquidation under 1992. Firm is terminated as a going concern, and trustees take over assets. This is the process for a liquidation of a firm. Like when the court declared that this firm is insolvent, then the liquidation process started. Liquidation process started means that there's the court orders some board of trustees, and the covered under the this bankruptcy is covered under this Act of 1992. Firm is terminated as a going concern means that the firm is not going to be do any business anymore. So trustees took over assets, sell them, and distribute the proceeds. That's a reorganization. Keep a firm as going concern involves issuing new securities to replace old securities, and depends on whether the company is worth more dead or alive. So there is a possibility that when the firm go for a legal bankruptcy, the court after getting arguments from both the parties, and they decide, okay, no, there is a need. It's not to declare that as a bankrupt. We allow the management to do reorganizing this firm, and then find out some a plan, or bring it some plan to get out of this situation. So in that case, it is possible that they reorganize, keeping a firm as a going concern. In that case, it is not terminated as a going concern. And then maybe the new stocks are issued, or replace the new old stocks, and try to keep it alive instead of declaring it as a dead. So this is all what I want to share with you from this chapter. As I mentioned before in our first lecture, that this video is going to available on two platforms. One is the same team platform, in which you can go to the channel, and from the channel you can watch that. The other platform is that it's my YouTube channel, uh, on which you can get the video of this lecture in an edited form, because sometimes there are some pauses, and in which I'm changing the screen, or screen sharing and all these things. That is going to be edited and make it shorter, so that you can watch it more quickly on my YouTube channel. And if you like, you can subscribe my YouTube channel as well, where you can find a lot of different subjects. It's a purely academic channel, in which you can find out many other subjects, videos on the different topics, like for economics, finance, mathematics, and all these things that you can find it out there. Thank you very much. Have a good day, and see you next week. Bye bye.